Thanks for tuning in to Grow by Joe. If you own a manufacturing business and you're looking to understand the different loan options that are available to you and your business, you definitely want to check out this video. Stay tuned. First off, I just want to say thank you for owning a manufacturing business, and I hope you're looking to bring some of that manufacturing back to the U.S. I know we can use more manufacturing here. Personally, I think manufacturing businesses are awesome, how you can create something out of nothing, and we love manufacturing businesses and have financed a ton of them over the years. And over the years, me and my team have helped finance over $2.5 billion of deals. And one of the core industries are manufacturing companies. So I'm going to talk about some of the different loans that are available and things that you should consider for your manufacturing business. Obviously, there's traditional banks, and I think if you can get financing at a traditional bank, then you probably wouldn't be watching this video. If you can get bank financing, I always recommend taking bank financing, whether it's a line of credit from your bank or if they're willing to finance some of that equipment for your manufacturing plant. Usually most banks will do that very well. Some of the local banks right now, as I'm making this video, have really tightened up in this high rate interest rate environment and all the things that have happened with the bank run. So everything under $10 million of lending, so $10 million or less, has become more and more challenging for banks, believe it or not. They want to do bigger and bigger deals, but most likely at some point you're going to tap out at the bank, or maybe you have tapped out the bank already and they won't extend more credit. It all depends on what you're looking to accomplish in your manufacturing business, and based on that will make up the product. So let me just talk through a few different products that are available today that you really should consider. So if you're looking to finance machinery in your manufacturing business, like injectables or molding machinery, things of that nature, any of the equipment that's in your plant, to the rack systems, all of that stuff is financeable today, which most business owners don't understand. There are equipment lenders out there that all will finance that stuff, typically over 3 to 5 year terms, sometimes even longer, up to 10 and 25 years, but usually 3 to 5 year terms, and they usually finance 100% of it. Monthly payments, low interest rates, single digits, to low double digits. So right now, interest rates are anywhere from 6 to 12%. The cool thing is, with equipment financing, any equipment you're buying, you should be using equipment financing. You could finance, $100,000, hundreds of thousands of dollars, or millions of dollars of equipment. We're looking at a transaction right now that's $7 million of rack systems in a very large warehouse. All that stuff is financeable over 5 years, low interest rates, monthly payments. The cool and good news is if you use financing, you can finance all of that equipment and still choose to depreciate all of it, or whatever portion of you want, this year or over X number of years. That's something that you need to speak to your accountant about, and I'm not giving tax advice, but the cool thing is you can finance all of that equipment over great terms, over a long period of time, low rates, long repayment terms, and you can still pick up all of that depreciation. So basically, you're able to preserve all of your cash, not lay it out, pick up all that tax benefit and preserve that cash to put towards other working capital needs in your business, or pull the cash out of your business tax-free and put it in your pocket. So that's something you should really consider. So next up are lines of credit. Now, you can use lines of credit in a few different ways. One, if you have B2B receivables, if you're manufacturing products and goods and you're selling them at Target and Walmart as examples, you can leverage those B2B receivables and access a revolving line of credit at really good rates. That's evergreen, meaning that line of credit will expand. Like, the more business you can book, the more invoicing you can do, that line of credit can fluctuate with your AR, and also some lenders will consider looking at your inventory. So as you stack more AR, as you have more inventory, you can pull from that line of credit to fuel your business. Now, that's a great tool and a great product to use to keep your cash flow rolling and take on new customers. So as you grow, you're going to need to fuel those cash flow gaps. You can leverage those B2B receivables, you can leverage that inventory, and use a revolving line of credit to help scale and grow your business. You can do that through banks and through non-bank lenders. So let's move outside of that. Let's say you don't have the B2B receivables. Maybe you're manufacturing and selling direct to consumer. There are lenders out there that will give you a line of credit and work off of your cash flow and give you something that's more revenue and cash flow based. What's really important with those products is that you're managing your cash flow and keeping money in your business bank account and you're not going negative. That's really, really important to make sure you're managing your cash flow. But there are a number of options out there today where you don't have to have those B2B receivables and can be selling direct to consumer. So separately, outside of equipment, outside a revolving line of credit, there are term loan options today that can be based purely on the revenue and cash flow of your business. Terms are typically 12, 24, and sometimes 36 months. There's also term loan products where some lenders will consider collateral such as inventory, equipment, machinery, things like that. So if you have things that are free and clear, they may be able to get you longer terms using that collateral. And then next up is SBA loans. Now, SBA loans are usually a longer process. The SBA is a 7A product that's 10 years that doesn't require any collateral and is based off of the revenue and profit of your business. And that profitability to make up what the loan size will be. Now, the cool thing with that is it has a nice 10-year repayment period. Those SBA loans, the 7A product, are really good if you're looking to acquire a business because you have a nice 10-year repayment. And you only need to put down 10% of that business purchase. Maybe you're looking to make repairs to your building, your roof, things that you don't have a quick ROI on and you want to pay back that loan over a longer period of time. Now, if you're growing fast, if you're scaling fast, I don't recommend an SBA product because you're going to want something that can be more evergreen and revolving, that can grow with the business. And I encourage business owners to look at more of a line of credit product, because what happens is when you get the SBA loan, it's like, oh, this is great. I get 10 years, I get a chunk of money. But the problem is, as your business grows, you need to keep filling those cash flow gaps as you book more customers, as you manufacture more products. You're going to need a line of credit that can really expand and grow with the business, and you don't want to be stuck and trapped into an SBA loan. So that's really something that is worth a discussion and understanding those options in more detail. And then lastly, is a product that we've been helping a lot of entrepreneurs and businesses with, is a subordinated debt product. So what that is basically, let's say you have a line of credit in place. We've seen a lot of business owners recently looking to refinance their bank loan and move to another bank. The reality is it might not be an option. It might not make sense to move to a bank. You may have a great deal. You can keep that line of credit intact, and you can actually use our sub-debt product where we fund you behind the bank in a junior position and where you keep your bank financing in place. The other cool thing is some of the other products I mentioned, like our equipment financing products. Those, you don't have to touch your line of credit from the bank or any type of financing that you currently have at the bank, and you can do equipment financing separate because the lenders are using that piece of collateral or that individual piece of equipment as collateral. So there are some different ways, and we're seeing the smartest entrepreneurs right now is they're not just working with one lender. They have multiple lenders and multiple products in the mix to help grow and scale their business. And the old way was work with one bank and they did all of your financing. What's happening now is a lot of banks or lenders are tapping out at certain dollar amounts, and you may have a good deal there where you don't want to touch that and refinance that, and you want to just focus and work with another lender on some additional capital, additional financing. Your opportunity, what you're looking to use money for to grow your business, will really make up the different products. All the different products that I mentioned, depending on what you're looking to get accomplished, will really make up which product that you should use. So if you have further questions, because again, your situation may be different than the next person watching this video, check out the link below. Schedule a call with my team. As I mentioned, we have done over $2.5 billion of financing, and a lot of that has been to manufacturing companies. So we're happy to talk this through. Thank you for tuning in to Grow by Joe. I hope you appreciated this video. I hope it was helpful. My #1 job is to help you grow faster and smarter. So again, thank you for tuning in, and keep growing.